Gold, since its last bear market low in 2015, it was $1,050. It's fourfold gain at this point in time on a ratio scale basis. It's 4 times the price of that. The 1980 peak was 8-fold gain from its 1976 low, and the 2011 peak versus its prior bear low in 2001, a 10-year bull market then, was an 8-fold gain. If gold merely matches the ratio scale bull market that it had in 1980 and that it peaked in 2011, gold would be well over 8,000 just to match the dimension of the bull markets that occurred then. Imagine if silver's 2% or 3% or more of an $8,000 plus gold, assuming gold only matches what it's done twice before.
Silver is entering 2026 with a technical backdrop that Michael Oliver believes is unlike anything the market has seen in decades. His analysis begins with a simple but critical observation. Silver has spent nearly 50 years trapped inside an artificial price range, while gold has already completed multiple full-scale bull market repricings on a ratio basis. That imbalance, according to Oliver, is no longer sustainable. When markets remain confined for that long, the eventual release is rarely orderly. Instead, it tends to be violent, compressed in time, and far larger than most participants are prepared for. Oliver now believes that silver's prolonged suppression is not a restraint. It is stored energy, and 2026 is shaping up to be the year that energy is released. What makes this outlook especially compelling is that Oliver is no longer talking about incremental upside or even a return to prior highs. He is describing a regime change. Having previously outlined scenarios where silver could reach $200 an ounce, he now argues that those projections may prove conservative. Based on historical precedent, ratio scale breakouts, and relative performance signals against both gold and equities, Oliver sees a credible path for silver to trade at several $100s per ounce, potentially as early as the second quarter of 2026. This is not a forecast rooted in speculation, but in recurring technical structures that have defined every major silver breakout of the last half-century. In this video, we'll walk through the precise signals Michael Oliver is watching, why silver's breakout against gold matters more than the headline price itself, and how monetary debasement is quietly reshaping the entire precious metals landscape. If you want a clear, disciplined framework for understanding why 2026 could be a defining year for silver and gold, stay with us. And if you find value in deep, market-driven analysis like this, be sure to subscribe and like the video. It helps us continue bringing this level of insight to the channel. We appreciate your support and hope you enjoy the video.
I think 2026 is going to be a very dynamic year for many markets, up or down. I think the monetary metals will continue up, but at an accelerated pace, particularly silver. I think it's going into a new reality. And by that, I mean it's not just going to take, let me explain it one way. Most people look at a price chart and they have an arithmetic chart, meaning dollar, and so forth. Like if you look at silver going back 50 years, you have a range from like lows at $4 and highs at 50, stuck in a half-century range. Very few assets in the world have been stuck in that same half-century range. But silver has, for whatever reasons. I think we know some of the reasons. Gold hasn't been stuck in that kind of range. It has had 2 8-fold dimension moves, 76 low to 1980, 2001 low to 2011. Both were 8-fold, well above the prior highs. But silver's been confined in the box. When you look at an arithmetic chart and you do your amateurish range objective, you've got a range from roughly, I call it 0 to 50, let's say, okay? Well, you're going to go to 100, and that would double the range. But when you put it on a logarithmic scale chart, a ratio scale, which I think is far more appropriate right now, that's a 10-fold dimension. In fact, our bear lows during that 50 years were $4 area. You went to 50, it's 10-fold, okay? From bottom to top, bottom to top. 10-fold above 50 is what? $500. If you backfit the price of gold by the degradation in the US dollar's buying power, or the yen's buying power, or the euro, whichever one, but we use the dollar. And you try to fit, where should the price be if it were at the 1980 high or the 2011 high, factoring in the degradation in the buying power of the dollar, the increase in the money supply? You'd be a couple $100 easily. It's not unusual for markets when they make mistakes. And we know this about like bubble tops in the stock market, for example. When they go too far one way for too long and then they break, often the downside overcompensates for the error in the prior overpricing. The same can be said when a market's been depressed too low, too long, and has in effect made a mistake or been confined. When the leashes come off, it often will compensate for it by going to the new reality, but it often will overshoot what you might say is a rational new reality, like, factoring in the price of silver balanced by the decay in the money supply. Maybe you overshoot that, and I wouldn't be shocked. But we've also done a lot of technical work at MSA based on a lot of other factors, but in particular importance is the spread or the relative performance relationship between monetary metals in the U.S. stock market. Divide gold into the price of the S&P and plot that chart over going back a dozen years. And you'll see there was a range that prevailed after gold collapsed in price and in relative value to the stock market. It collapsed down to roughly 50% of the price of the S&P. Either side of that for the last actually 11 years since 2014. And that spread chart, when you plot it, is like a base after a big drop. You broke out of that base in November, relative performance gold to the S&P, and further in December. And when you plot that same chart, silver versus the S&P, you also broke out, except more gushingly. And then when you run a spread chart, or relative performance valuation chart of silver divided into the price of gold, take an ounce of silver divided into gold, express that as a percent. Back in 1979 to 80, silver was 6.5% of the price of gold per ounce. In the bull market that peaked in 2011, 2010 to 11 period, the spread surged up to 3.1% of the price of gold. The low early this year was down at 1% of the price of gold. So silver, while it was advancing since the 2015 bear low, just like gold had been advancing, was advancing far less. Therefore, its relative performance was anemic. Silver's now up to 1.7, I think, percent of the price of gold. So it surged massively. You buy something like at $100 and it goes to 170. That's like 1 to 1.7%. So it's surged a lot in the last few months, but it's broken out of a decade-wide spread chart base, where technically if you analyze the spread, forget the price of silver or gold, just the difference, you had this basing pattern, and silver has broken out in spades, exploded. That is a very important technical. Two prior examples of such spread breakouts where silver went from less underperformer to gold and had a basing type pattern and broke out. It exploded in price over the next couple quarters. Back in 1979 in the summer, as silver had already been in a bull market for a couple of years, and that's when silver went from like the teens to $50 in 5 months. Huge multiple gain. The spread breakout is the technical factor that told you, something's about to happen. You go over to the 2010 bull market, which had already been going up for years in silver and gold, but silver had been underperforming gold and had been caught with a ceiling on the spread chart. Bang, bang, couldn't get above it. In September of 2010, silver was about $20, and boom, it went up double and a half in the next 7 months from the price level it was when that spread broke out between September 2010 and April 2011, when again it hit the top of the old price range. But the spread told you the game is changing. Silver's now an outperformer. And that's when the net price of silver went berserk, double and a half in 6 months.
From Oliver's perspective, 2026 is not just another bullish year. It is a transition point. Silver is moving out of an arithmetic mindset, where investors fixate on past highs near $50, and into a ratio scale reality where historical suppression becomes the basis for exponential repricing. When viewed on a logarithmic scale, silver's 50-year range is not modest at all. It represents a 10-fold compression, and when such structures resolve, they tend to do so rapidly. Oliver's work suggests that once this process begins, silver does not drift higher, it accelerates. That acceleration becomes even more important when silver is analyzed relative to gold and the broader equity market. Oliver has identified decisive breakouts in silver's relative performance versus both gold and the S&P 500, signals that historically precede silver's most aggressive advances. In the next segment, he explains why these spread charts, rather than headline prices, are the clearest indication that silver is shifting from an underperformer to a market leader.
The situation here is the same, except even clearer. The base is bigger. Like I said, it was 10-year wide, where silver was confined versus gold. It broke out in November, and it broke out even another structure in December and exploded. Look what happened to the price of silver since November and since December compared to what happened to the price of gold. They both went up, but silver exploded. But if we set the clock again and assume that this could be a couple quarter process where silver goes, not only beats gold, but does so rapidly and causes price to go up, expect much of this to occur in the next 6 months since that November and December breakout, meaning sometime in the second quarter, perhaps. Don't be shocked if silver's several $100s an ounce. That's our expectation based on that analysis and some other factors as well. Yes, gold will have gone up during that time nicely, but silver will have beat it and regained, perhaps even challenge the spread chart highs we saw in 1980, over 6%, and over 3% in 2011. And again, we're still below 2%. So that percent gain is enormous. And also factor in this fact, which few people know. Pardon me for being long-winded here. Gold, since its last bear market low in 2015, it was $1,050. It's fourfold gain at this point in time on a ratio scale basis. It's 4 times the price of that. The 1980 peak was 8-fold gain from its 1976 low, and the 2011 peak versus its prior bear low in 2001, a 10-year bull market then, was an 8-fold gain. If gold merely matches the ratio scale bull market that it had in 1980 and that it peaked in 2011, gold would be well over 8,000 just to match the dimension of the bull markets that occurred then. Imagine if silver's 2% or 3% or more of an $8,000 plus gold, assuming gold only matches what it's done twice before. So anyway, that's the dynamics I think we're facing in the monetary metals. But when a market has made a mistake and stayed confined too long, and I'm talking about being depressed now, copper went through such a situation. If you go back and look at long-term copper charts back in 1970, 1980 to 1990 into about late 2005. So multi-decade range, copper was in a range from roughly 50 cents to $1.50, back and forth and back and forth. That was its old reality. In late 2005, it broke out of that price reality. In a matter of a couple quarters, quadrupled in price, up to $4.50 an ounce, per pound. And lived in a new range after that. Oh yeah, it had some sell-offs after that explosion, but literally in the several quarters, it quadrupled. It didn't incrementally go up to a new reality, it exploded. Lead, a very dynamic market, was in a similar range-bound reality from the same years. And in 2007, a year and a half after what copper did, it also broke out of this multi-decade, very depressed range and went up, quadrupled in price in a couple quarters and lived in the new reality after that. Why has silver still been confined in that old reality that goes back into the 1970s? What is it, dirt? Or has it been contained by various measures? And that we're not going to get into that issue except to say lead did it, copper did it, gold's done it. Why is silver contained in a 50-year range? When it breaks out, you think it's only going to go up the same arithmetic range, or is it going to do like a quadrupling like copper did or lead did? Or look where gold is now versus its 1980 high. It's $4,500 gold versus $850 high. Where's silver compared to its 1980 high? It was $50 then. It's 80 now. It's trivial compared to what the ratio scale move of those other markets have been ongoing. I think silver's going to catch up, and it's going to a new reality. And we know there's fundamentals behind it. Supply-demand situation for silver, industrial demand and supply, has been deficient for 5 years plus now, where there's just not enough supply to match the increasing industrial demand. High-tech industrial demand, solar panel creation, all these things are consuming a lot more silver than we produce. And despite the higher price, supply is not increasing, primarily because silver really doesn't come from silver miners. It comes from base metal miners. And so that silver price is not an incentive so much for them as it is the price of the underlying base metal that they're out to get. Anyway, those dynamics are now in play, and I think they're going to rapidly go to the new reality and probably even overshoot a rational new reality. And then there's also the other macro fundamental underlying silver. It is money. Don't forget that. And as gold rises, the monetary metal, silver is also monetary metal. Don't forget it, going back thousands of years. And as we get into government debt crisis problems, which we're on the cusp of now entering, our assessment, hence weakness in the stock market, it will follow that. Not necessarily dramatically in the first 6 months of this year, but probably later in 2026, we'll see some sharp stock market decline. Right now, frankly, I think the stock market is probably going to incrementally hold itself together and maybe even rally for another month or two. And any sharp decline, which I know a lot of silver and gold owners are fearful of because they think there's a correlation, and there's not. It's not a good correlation that if the stock market drops sharply, so must gold, for example. But even that type of event, I don't think is going to happen until we get mid-year this coming year. And goodness knows where silver and gold might be, especially given our analysis that in the next 6 months, we should have extreme drama. So again, there's not just the industrial demand, supply-demand problem for silver. It's the monetary underlying crisis that is out there and is not going to go away this time.
Michael Oliver's confidence in silver's trajectory is rooted in a framework that combines long-term technical structure with macroeconomic reality. One of the most important points he makes is that gold itself is not extended by historical standards. Since its 2015 low, gold has achieved roughly a four-fold gain on a ratio basis. In both prior secular bull markets, 1976 to 1980 and 2001 to 2011, gold delivered eightfold advances. Simply matching those historical dimensions would place gold well above $8,000 per ounce. In that context, silver trading at a few $100s is not extreme. It is mathematically consistent with past precious metals cycles. Silver's role within that framework is particularly compelling because it has always been the higher beta monetary metal. During true precious metals, bull markets, silver does not merely follow gold, it outperforms it, often dramatically. Historically, silver has traded at between 3 and 6% of gold's price during major cycle peaks. Today, it remains below 2%. Even a partial reversion to prior ratios implies multiples of upside from current levels, especially if gold continues its ascent. Oliver's analysis suggests that this relative performance shift is already underway, and that silver's recent breakout marks the beginning, not the end, of the move. Beyond technicals, the macro backdrop reinforces this outlook. Monetary debasement is no longer a theoretical concern, it is an observable reality. Expanding money supply, sovereign debt saturation, and declining purchasing power across fiat currencies are driving capital toward assets with no counterparty risk. Gold has been the primary beneficiary of this trend, but silver remains materially undervalued relative to both monetary history and industrial necessity. As governments struggle to manage debt burdens, confidence in financial assets becomes increasingly fragile, creating an environment where monetary metals regain strategic importance. Silver's industrial fundamentals add another layer of pressure. Persistent supply deficits, rising demand from energy transition technologies, and the fact that most silver is produced as a byproduct of base metal mining severely limit supply responsiveness. Higher prices do not immediately bring new silver online. This structural constraint means that when investment demand accelerates alongside industrial demand, price becomes the balancing mechanism, and that adjustment tends to happen quickly, not gradually. Oliver's outlook for 2026 is therefore not one of fear, but of opportunity. He anticipates volatility, particularly as equity markets begin to reflect underlying debt stress later in the year, but he sees silver and gold positioned to benefit rather than suffer. In his view, silver is not simply catching up, it is entering a new pricing reality, one that may ultimately overshoot rational valuation before settling into a higher long-term range. If you're navigating the precious metals market with a long-term perspective, 2026 is shaping up to be a year worth paying close attention to. Thank you for watching, and if you found this analysis valuable, don't forget to like the video, subscribe to the channel, and share it with others who are serious about understanding where the silver and gold markets may be headed next.